Hi, this is Sam with this episode of the Living Working Abroad show. Thanks for joining us today. We're going to take a deep dive into a couple of specific tax issues today to look at tax creep for expats living and working abroad. Two specific areas. We're going to look at the tariff and the tariff wars and the Liberation Day kerfuffle that's been created by Donald Trump, and what does tariff really mean? And also, um, we're looking at dividends, and specifically that for expats, dividends is a movable income, and what does that mean in the EU? So that's what we're looking at today. So thanks a lot for joining us. What we've seen over the last week for expats living and working abroad is that there's been a great kerfuffle going around where the people have been um, uh, uh, reacting to the Liberation Day talk on the 2nd of April from Donald Trump. He's imposed massive tariffs on many countries, including some impoverished countries like Australia, impoverished countries, third world developing countries, including Australia, where there was no tariffs before. They've imposed a 10% tariff on Australia anyway. And then the massive 100, 150, 200% tariffs on China. What this has done is big impact around the world, and suddenly shipping companies, trading companies are stopping shipping their stuff. The double whammy of what Trump has done with his Liberation Day is that he was going to impose the tariffs a week later. Now he's put it off 3 months. So if you're a trading company and you're shipping, £10 million worth of goods to the USA, you're going to say, hang on a minute, I'm going to hold it here, in Shanghai or in Europe for 3 months and see if the tariff war gets solved and could save me £10 million or £2 million or £10 million at least in tariffs from sending those goods to the USA now. Not very good for the USA. So at the same time as all this is going on, Trump wants to see interest rates coming down in the USA. And so he's lined up his head of the central bank for not reducing interest rate. Well, with all due respect, you're creating a trading uncertainty, Mr. Trump, and that uncertainty, that gap in trading where people take a 3 month gap, that is called a recession. Now, whether that recession spreads to the rest of the world, to Europe, Asia, Africa, as well as America, who knows? We will see. But at the end of the 3 months, what we're looking for is to see progress on those trade deals and potentially a new world order. So let's take a deep dive into our main event today. We've got two features. The first one is we're going to go a bit more into this trade war and what that means. One of the comments that Trump has made this week is that he doesn't like VAT taxes. Well, let's have a look at that in a bit more detail. What he's doing is imposing a tariff so that if you're sending goods into America, there's at least a 10% charge to import that into America. Now, the difference between a tariff and a VAT is that when a company trades into the country, the tariff is charged at the border, so you have to pay 10% to import into America. With a VAT tax, that's an internal tax. So if you've got a consumption tax, a sales tax, so if a company or an individual or business is buying goods or services inside the USA, then a sales tax will be charged there, maybe at 10%. Now in Europe, you've got the wonderful Europe project, which is designed to create a free market in Europe. But the EU introduced and imposes a VAT tax. It is essentially an EU tax, a consumption tax on everybody in the EU. Now the rates vary from country to country, but the idea is that it creates a tax to pay for the EU bureaucracy and the extra level of government that the EU has over other countries. But at the same time, it's a trading expense. So anybody that's buying goods and services from the EU potentially has got a VAT liability if you're within the EU. If you're trading outside, if you're buying from overseas, if you're exporting from the EU, you don't necessarily have to pay that VAT. It can be deferred over to the other country. Now, the UK, when they left the EU, they could have abandoned VAT as a consumption tax on any individual business buying stuff, but they didn't. They chose to keep it in place. So the key benefit you could have thrown away straight away and had a free trade deal with the USA. So you could have said to the USA, UK, we'll trade for you. There's no tariffs, but they didn't. They kept their VAT in place, and so any American companies, anybody inside the UK has got that additional expense. So that's what a consumption tax does. The tariff charges at the border, the VAT tax charges inside. So they're pretty much the same type of thing. And this is our point really, is that when we're looking at this, a tariff is another form of consumption tax, which is applied, but when it's going across a border. The VAT is a consumption tax that's paid only by locals. Um, so within the EU, the VAT it creates, helps foster and pay for the closed shop in the UK. But if the EU and America can get a free trade agreement, then you could be tariff free and VAT free between the two countries potentially. So you've not got the consumption tax being charged to um, overseas companies and travellers inside that country. So the two versions of the same thing. So in effect, Trump's tariff proposals are creating this worldwide tariff loggerhead. And what he's trying to do, ostensibly, we understand, is create a free trade zone around the world. So free trade means free trade. It doesn't mean that sales taxes and tariffs on the borders of China or the EU mean that those countries are paying um, that they're getting a trade surplus because their goods appear cheaper in the other destination. I'm not doing professor of economics here, so to understand me, we're just trying to look at the general picture and the outside world. You can also argue that tariffs have got a great way of balancing up a trade balance. If China's got cheap labour, cheap infrastructure, cheap power, then that's the way it gets a competitive advantage against America. So the downside of Trump's tariffs campaign is to make his expensive infrastructure country more competitive with a cheaper country. So the competitive advantage of a Cambodia or Vietnam or a Philippines or an African country or even an Indian country with the USA and lower costs, low employment or regulation costs is eaten away by the tariff charge. So those are the issues at play. If it creates more free trade, if it can trade no tariffs and no sales taxes, then that could be a good thing for all. A consumption tax may be necessary to balance the books for a government, but it could be one way or it can be another. It doesn't have to be all or nothing. And we'll look at that in the second part of our webinar this afternoon, coming up next. If you want to contact us for a free review or to discuss expat business and investors living and working abroad, or consider the options of where you're going and what you're doing, you can contact us at proactpartnership.com. In this next episode of the Living, Working Abroad show, what we want to do is look at a deep dive into dividend taxes. Now, dividend tax is a movable tax. What it means is that it moves with you. So every entity can potentially become a tax entity. That entity that's taxable could be a company, it could be a sole trader business, it could be an individual, it can be a trust, it can be a charity, it can be a property. All these different things pay different types of taxes. And one type of income that an individual or business can earn is dividend income from shareholdings in investments. That income that's paid to them is not taxed in the country in which it's sourced, it's taxed in the country in which you, the receiver, is an individual tax resident. So in America, how companies manage that is that they create a Cayman Island, a compliant Cayman Island offshore company with 0% tax rate for their corporation tax rate, to make a break between their UK trading and their holding company in the Cayman Islands, often with a third company in between the two, where there's transfer pricing rules do apply, of course, for big companies. For smaller turnovers, not necessarily. But what that means is that the management of the company, if it's from a 0% or a 10% or a 15% corporation tax jurisdiction, and it's invoicing out revenue from the high tax, the 20, 30, 40% tax revenue, then this becomes a tax saving. So that's a way of reducing corporation tax for companies trading across border. We first had income taxes introduced 300 years ago, and then government started to introduce taxing savings taxes as well as dividends, the interest that you earn. When your shares make a profit or you build a business, they introduce capital gains tax, and then the property that you own and you invest in, the capital gains tax on that. The business that you build, you get a corporation tax. Now, the good thing is with corporation tax, are often flat rate taxes rather than progressive income taxes. And lately, we've seen the G20 pressing to introduce wealth taxes around the world. So, for example, there's a solidarity tax in Portugal for anyone earning over 80,000 euros. And other countries have got their versions of that. And of course, as we mentioned earlier in our show today, there's VAT taxes, sales taxes, consumption taxes, which can be charged as well. In the UK, we recently mentioned, and you can check again at our Living and Working Abroad show on YouTube, where we covered the increase in council taxes on second homes in the UK, which again is doubling the tax by 100%. As a way of generating extra revenue for government directly or indirectly through the local authority. So there's many such issues with that. So with dividends, they move with you. So if you've got a company that's paying you dividends because you're an investor or because you're a business, then that dividend is taxable. So if you as an expat, your company, or you as an individual choose a jurisdiction where you get low dividend tax, then potentially you don't need a salary, you don't need an income, you don't need to receive interest, you could receive dividends with a lower overall tax rate. And that's what we want to look into today, and look at some rates that are potentially chargeable in the EU. Now, the highest dividend tax rate in the EU is Ireland with 51%. So you get lower corporation taxes and maybe income taxes, but dividend taxes are 51%. So no thank you very much. In the UK, they're very happy to charge dividend taxes. Over the last couple of years, they've reduced massively the personal allowance on dividends. It used to be in addition to the personal allowance on income. Now there's a personal allowance on income and a small amount on other types of interest and dividends and gains. And so the personal allowance have been rapidly reduced, forcing up the overall tax bill for people, even if the rate has not been increased. So in the UK, you can pay up to 39% on dividend tax. So if your income is 150,000 a year, and you get 50,000 dividend tax, you're paying 40% tax on that 50,000 dividend. That's £20,000 of additional tax. In the middle of Europe, you're normally paying about 26% on dividends. And in the Baltic and the east of Europe, you can get down to 15% or low. Some of the highlights on dividend tax for your business or you as an individual is, for example, Greece, where the dividend tax rate is 5%. So if a UK expat operating out of a personal service company in the UK was a tax resident in Greece with no other income other than the dividends receiving as an investor or a business or both, then the dividend tax rate is 5%, which could be quite attractive. However, you can go a bit better than that, because Malta, Latvia, Estonia have got a headline rate of 0% dividend tax as well. Now, it's not to say that there's not other taxes, but there is nominally a dividend tax rate of 0%. The reason it's 0% in Malta is because you can offset it against the corporation tax rate. So corporation tax rates in Malta are 35%, which is quite high, but you can offset any dividends you pay against that to effectively bring the dividend tax rate down to zero, i.e. you don't pay any more than 35%. So I don't include Malta in that. One thing that's often missing from the headlines is that an expat individual living in Cyprus as a tax resident pays 0% dividend tax. They also pay 0% interest. So if you've got a holding company in Cyprus that receives income as dividends or interest, by the way, from abroad, is 0% tax. If you're an individual who owns a company or has got an investment portfolio of shares that are receiving dividends, that income, that dividend and interest income as a Cyprus individual resident is 0% tax. Not exempt, is 0% tax. So your home country can't tax that. That dividend income has come with you to Cyprus, and it's 0%. It's not 25%, it's not 15%, it's not 5%. It's not 0% subject to paying 35% corporation tax. It's 0%. So it can actually work quite well. So if the shareholder, be they an investor or businessman, is tax resident in Cyprus, as an individual, they can have a 0% dividend tax rate. Now, that means you've got to live and work in Cyprus if you want to do that. So what's the other ways around that? You could also consider a Cyprus holding company, but then you get a corporation tax free. Now in the UK, corporation tax is up to 25%. In Cyprus, corporation tax is 12.5%. So there's a 50% tax reduction on that. A point to note there I didn't make earlier is that dividends are always paid out by a company after corporation tax. So if you're running your own business, you're still going to have a corporation tax liability. If you're an investor, you're just receiving the dividends. So an individual investor can receive income from abroad at 0% tax on dividends. A company can receive a company based in Cyprus can receive 0% tax dividends as a holding company, but the corporation tax would have to be paid in the company that's being paid from. If you create a corporation in Cyprus, you're going to pay 12.5% corporation tax, but the dividend, if you are qualified as an expat living and working abroad in Cyprus, can still be 0%. So it becomes quite attractive. Now, if you're setting up an overseas company, management and control has got to be from that jurisdiction, and therefore that creates an additional level of costs. So a third way around it that Proact can consider with our clients that are living and working abroad is a trust, either a business trust or family trust, that can then hold the shares of the business and be a resident relatively cheaply in Cyprus and receive the dividends with zero tax. So it's quite a simple process, but it is simpler to manage than an audited compliant Cyprus company. And an international trust in Cyprus will pay no tax on worldwide income, only on Cyprus income. So a family trust or a business trust in Cyprus works very effectively for a holding company option or an individual who wants to be living and working based in Cyprus with zero dividend tax. If you want to discuss that in any more details with them, contact us at proactpartnership.com. We offer free reviews to people living and working abroad or relocating overseas. But if you want to live and work within the EU, consider what the best way is for you to work as an investor or personal service company, or holding your assets while you're an individual elsewhere to accumulate 0% tax on your business and investments. You can contact us at proactpartnership.com. Thanks a lot for listening. Hope you found it interesting that today we've looked at a deep dive into tariffs and the comparison with VAT as a consumption tax. A tariff is a consumption tax for a business. VAT is a consumption tax for the individuals and businesses within a country. It penalises trade, especially for people outside. A tariff is a charge going into the country and can create additional costs and expenses for whatever reason. We discussed that Trump Liberation Day, is it to level up the tariff charges between countries or the trade imbalance, or is it to create a free trade zone in the world in the years ahead? Of that, we wait to see in the next 3 months. Meanwhile, we've got chaos. We look a deep dive on dividend tax to see that in Europe, you can pay 50% dividend tax, or you can pay 0% dividend tax. You can pay 0% dividend tax and 35% corporation tax. The choice is yours. Whatever works for you depends upon your circumstances. And that's why at Proact, we offer a free review online to discuss what might work for you and what might offer you the opportunity to live abroad, to work abroad, or to hold your investments or your business assets abroad to avoid income taxes, dividend taxes, interest taxes, VAT taxes, and obviously the final one, when you're selling up, capital gains taxes, and when you die, inheritance taxes. They could all be zero, depending upon your circumstance and your wish and your desire on a country to relocate to. For more information and guidance, contact us at proactpartnership.com. Thanks a lot for listening. We'll see you next time.